Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, June 12th, 2017. I'm starting this video after the markets closed, so today's trading is over. It was really a non-eventful day. However, there's a few things that I'm watching I do want to point out. I wanted to put this together in just some static charts and a few notes on the site for you guys to read and charts to look at, but there's quite a bit. I'm not going to go over a lot of. I'm only going to go over a handful of charts, a handful of sectors, and a couple indexes, and then that's it. But I'll tell you what I'm watching, what stands out to me, and my thoughts on the action both today and Friday. Start out with a tidbit. I shared this in the trading room. I was reading an article in the Journal, the Wall Street Journal, regarding Friday's pullback, and I'll read this verbatim. It just says. Friday's pullback in technology stocks bears closer attention than usual, coming out of the blue and unusually not being part of a wider sell-off. Well, we know it wasn't out of the blue. All the charts on the FANG stocks aligned perfectly. They all broke down at the same time. Apple broke that trend line we've been watching. So I'll argue that all day long. It wasn't out of the blue. So it's clearly a technical event. And that's what happens in a momentum-fueled market. Everybody was chasing technology. What was unusual, as the author mentioned, was that to see such a big down day in the tech sector. And let me go on and just finish. He states that the fall was small in absolute terms, but it looks huge compared to everything else. In other words, remember the S&P hardly blinked. All the other major diversified indexes didn't blink, but as I've always maintained, QQQ, even though it is an index, it's 100 stocks, I call it a tech fund with an Amazon kicker because it's mostly tech stocks in there. Over half the performance of the Qs are due to tech stocks, and over half the performance due to the top 10 stocks alone. So he goes on to say the S&P 500 tech sector had only two worse days relative to the wider market since the post-dot-com bear market ended in 2003. So once again, since the end of the dot-com burst, that bubble burst in 2000, the bear market ended in 03. Since then, we've only had 2 days where the tech sector had worse days relative to the broad market, S&P 500, the Dow, everything else. One of those was amid the post-Lehman carnage in October 2008, and the other after the market began its credit crunch-induced descent in late 2007. So just kind of put it in perspective, that's the only other times since that tech bubble burst back and that bear market ended in 03. So take it for what it's worth. Now, we need to see follow through. As I said, yes, it was certainly a bad day in the NASDAQ and in the tech stocks. I'm going to talk on that now and just tell you what I'm watching for. These are the semis, as most everybody knows, if you've been following the market of tech, semis have just been on a scream. They've done phenomenal. It's a momentum trade, and this is what happens when people start buying stocks no longer for their fundamental values or prospects, but because everybody else is buying them. They're buying because it's going up. And that's what causes the market or any security to get ahead of itself. And the same thing happens on the downside. Selling begets more selling, especially during a strong downtrend. So, and what happens is when you get a rush for the exits. Now, this is just today down 0.7% in XSD. That's one of the semiconductor ETFs. But what I had mentioned before is this huge bearish engulfing candlestick that we had on Friday, which mauled, at least the last couple weeks of trading. And you can see, interesting enough, where we closed today, right here's a support line. You can see a reaction there, and we closed right there. We have confirmed negative divergence now in the daily time frame. That's coming with an overbought reading. Doesn't look so good. So my take on the market and on tech, I'll just be clear on that, is I think today was a consolidation day. I mean, no doubt it was a consolidation day. For the most part, everything was about flat. 0.7, a 0.7% loss on the semis. A gain or loss is really run of the mill. Because they're a very volatile sector. But if you look at this, and I have it drawn out on some other ones, we had a member Get It Right also pointed out earlier these potential bear flags or bearish pennant patterns on the semis. So there's one of them. Here's another semi ETF, SOXX. You can see on a 60-minute chart we're looking at a bearish pennant. You see the impulsive move down, the flagpole, pennant. If you want to call it a flag, maybe you could draw a flag on some of these. Now, whether it meets the true definition of pennant, my thoughts were we had a little bit of momentum-fueled overshoot, and then we snapped up, and then the pennant formed. Either way, what you cannot argue is that this is a very powerful impulsive sell-off with an area of consolidation. And if you look up the definition of a bear flag or bearish pennant, that's the nature of it. You have a swift move down, followed by a period of consolidation, which typically takes the form of a pennant or a flag. And then, so what we need to watch for here is a breakdown out of that flag, if that indeed is a bearish pennant. And the measurement rules, you take the distance of the move leading up to the pennant formation, and then you add that to where it breaks down. And if you look back here, you can see some support. I haven't really marked this chart up, and I apologize for that. I have a lot of charts here. I'm trying to hit this gap. I'm not drawing it perfectly with these tools, but you can see this gap down here, reaction, and that would be an ideal target. So if you ask me where I think the semis are going, I think that'll play out, but let's not get ahead of ourselves, because this was a day of consolidation. You know, we had a breakdown in the semis a couple months ago that I thought was a real deal, and they reverse gunned it, went the other way, and went on to new highs. Just because that happened once doesn't mean it's going to happen again. And in fact, the more overbought these things get, the more severe the correction will be when it comes. So that's what I'm watching for. And the only other one was SMH. Let me clear the annotations out. SMH. Here we go. And there you can see that flag. It looks more like a, this one's more like a, you can draw a flag if you want, look like that, a bull flag, or you can come in here and draw a pennant. Doesn't matter. To me, 6 to 1, half dozen to the other. Those patterns have the same meaning, the same implications. And what you want to watch for, again, is a downside break, impulsive, especially if and when we take out these recent lows right here from the other day, and you want to see volume expansion on the move down. Those are the criteria you want to look for if that's a flag pattern. So if you're quick enough and you catch it right, there may be some meat left on the bone. Now, if we gap down tomorrow, that would obviously be an impulsive move, a gap down, and it might not provide such an objective entry if you're already short. I'm sorry, unless you're already short. What I also wanted to bring up in this video is, at this point, you know, lately I've been living, if you've been following the analysis on the site, I've been living in the charts of the intraday time frames, 10-minute charts. I've been putting up a lot of 10-minute charts, which is uncommon. I don't usually do that. As a swing trader, my preferred time frames are the 60-minute, daily, and weekly charts. But we've been in a slow grind, you know, sideways to, depending on the index or the sector, sideways to up market for months now. You know, I talked about the small caps in a 7-month sideways trading range. So when that happens, then you start moving down to the shorter term time frames. And if you're not an active trader, just stand aside, wait until the market breaks one way or the other. But with that being said, we've now broken down all those 10-minute patterns I was putting up, trend lines, support levels, even the 60-minute charts. They have clearly and impulsively broken down. Yes, this market in the last year or so has been plagued with false sell signals, especially in sectors like the semi that have been extremely strong. But once again, that doesn't mean that's going to continue forever. You know, if it's cloudy outside, I see dark clouds, storm clouds coming. I think it's going to rain. I'll go inside or grab an umbrella, and you know, 9 times out of 10, it's going to rain if you know, the storm clouds are blowing in overhead. Once in a while, the rain will miss you. So this is technical analysis. My analogy is, you know, we have a breakdown here. We have extreme overbought levels, and just because we've had a few, you know, tough whipsaws, false breakdowns like this one. This is the one I'm talking about right here on the semis. We had a very well-defined uptrend line, and I really thought that was a real deal. I had a high degree of confidence. I'll say it now. Took my licks, you know, on that, shorting the semis, but I'm back in them now, and this is, you know, looks really good to me. Here's a minor trend line. Here's that old trend line, which probably still has some validity there, because this was a brief breakdown. We snapped back above it. We broke down. And now we're below this minor uptrend line, which is really, you could draw that on the 60-minute chart as well. So enough on the semis. That's what I'm looking for there. And remember, when we move back out to the daily time frames now, the targets I was giving on the 10 and 60-minute charts, those are very near-term targets, and those targets were hit. And if this bull market, and at least the bull market in tech and semis, has more room to run, and it's not anywhere near a top, then those very quite possible might be the only targets that get hit. So depends on your time frame and what your views on the market. However, these divergences I've been pointing out, they've only continued to build. They're still intact. And I think the case can be made for, still believe the case can be made for a significant correction in the semis. I'm talking a drop, at minimum coming down here another 17% or so. I think the case can be made. I should say at minimum swing target, let's be more accurate, from the highs would be down to about that $80 level, which would be a drop of about 11% off the highs. Not that much left to go from this point, but I just want to give you guys price targets. So roughly another 5.5% minimum. And I still think it's very likely that $74 area will be hit, which is about another almost 12.5% below current levels. All right, so that's it on the semis. I give you let's keep an eye on those 60-minute charts. Let's watch those flags or pennants. And remember, just because the market didn't tank again today, we had one of the largest drops, particularly in tech stocks, in many, many months, if not years. And in the very short-term time frames, the 5-minute charts, 15-minute charts, 10-minute charts, we became very oversold. And the fact that the rest of the market didn't follow means the tech stocks are only going to go down so much. Now, I take it as bearish today, the fact there was more downside on the semis. The Qs as well followed through on the downside, another down day. So they had the opportunity to snap back and undo some of that. They also had a big bearish engulfing candle on Friday. They had the opportunity to come back in and maybe question that breakdown, question that bearish technical event, but they didn't do it. We saw more selling. The FANG stocks were down today, and I still maintain these as very likely targets. I've covered those before, so I don't want to go over that again right now. However, what I will do is, again, I've been living in the intraday charts, even with the FANG stocks lately. Let's look at the daily charts, because now that those have played out and already hit at least some of my earlier targets, let's see where this thing could go if things get ugly. And the one thing I will tell you as a trader, do not become complacent. Maybe this was another 1 or 2 day wonder and the market just continues on to new highs. Maybe not. And if it doesn't, the one thing that's almost a constant in trading is that stocks fall much faster than they rise, especially after very extended runs, extreme overvaluation, sentiment, and all that good stuff that's already baked into this market. So the potential is there for a very swift sell-off. As you guys know, even in Apple, the world's largest company, I've been calling from this point here for a 14 to 18% correction. We're, so far about a third of the way there. We were, at least at today's lows, close up a little bit above that. So there's still, quite a bit of downside left in the charts. And again, it's all priced in. So what I'm doing now is zooming out to the daily charts to just show you where I think things might be headed. And I'm pretty sure by the end of this week we'll have a good idea. I'd be amazed if they can park the indexes or ramp them into OPEX. We do have options expiration this Friday, standard options contracts expire third Friday of the month. Boy, I tell you, if they manage to hold this market up for another 4 days, I would be surprised based on what happened Friday. Again, a little bit of follow through in the tech today, but there's still a little more work to be done. And I'll get away from tech here in a second, but I wanted to look at these FANG stocks. You can see all these trend lines. Prices have respected each and every one of these trend lines. But probably the most significant development here on Alphabet is this rising wedge, the white lines with the divergent high, long-standing divergent high, and we had even shorter-term divergences there. That's also the wedge I showed on the 60-minute chart, so that's really nothing new. But to give you an idea where Alphabet might be going, here's a long-term primary uptrend line, and I'm just going to use a measuring tool roughly from where we closed today. I'm going to just assume it gets there soon. That's about another close to a 10% downside, another 10% downside. And look, there's also a big gap right here to fill. So maybe we come in, test the top of that gap. That would be your first support level, roughly 901.55. Bottom of the gap, if the gap is entered, it'll probably be backfilled, and that'll take you down to about 878. And from there, you have the uptrend line of support. Next one up, Microsoft. Here's an uptrend line, pretty well defined, big rising wedge if you look at this uptrend line and this white uptrend line here. Negative divergence, same story across the board. These divergences continue to build, and they've even steepened here on the RSI recently. So you have called double negative divergence. There's a minor uptrend line below, but this is the big one if this white one cracks. And there's also horizontal support. So really what I see here is, when I look at this chart, is a confluence of support, pretty important support levels right there. And if that goes, that's a breakdown of this much larger wedge. I mean, this wedge goes about 1.5 years. The trend line goes back almost a year now. Yeah, it looks like about a year. It started back in mid-June. And so there's a level to watch on Microsoft. Amazon, very clean. You know, I pointed out the rising wedge on the 60-minute, which is actually, if you look at this line and this one here, that's that 60-minute rising wedge. So that was the catalyst, the spark that gave us that big sell-off and the mini crash on Friday down to this primary trend line. I think I already talked about that this morning. So this is your level to watch. I'll even set a price alert now. Probably should do it on the rest of those. And again, anything can happen. We might have another thrust up within the wedge go down. Maybe these divergences are burned through one day. I don't know. There's a myriad of possibilities, but I can tell you this, that it wouldn't surprise me to see this thing really get going to the downside quick. And my preferred minimum target here on Amazon, especially if that wedge breaks, is down here around 850 or so. So you're talking a drop of about, I don't know, another 12.5% or so. And again, that would be a minimum target. If that goes, you can see these additional levels here. Last one up, Facebook. Same story, negative divergence. These divergences, you look here, have steepened recently. You have a steep drop off. The PPO and the RSI are severely lagging. They're putting in lower highs against that recent high in price. We broke down. Not crazy about this trend line. It doesn't fit perfectly, but either way, it's something to watch. But most importantly, again, if you just strip all these levels away, you look at the candlesticks alone can tell you a lot. There's a huge bearish engulfing candlestick that engulf weeks of trading right there, and then follow through today. I often say that. Candlestick patterns can be very good at identifying major inflection points in the market. One-day candlesticks, such as a bearish engulfing, a certain doji, or this and that, in itself really isn't enough to get me too excited. It's that second day. I like 2 or 3 day patterns. So far we had an additional follow through on the downside on most of these tech stocks today, which helps to validate, unlike that ramp that we had, the breakdown or the big down day in QQQ recently. You guys probably remember that. Remember this big bearish candle we had here? There was absolutely no follow through. Markets turned around, closed green the next day, and went up. So that's not the case here. We have a much larger red candle, bearish engulfing candle, and follow through to the downside. All right, a couple more and we'll wrap up here. So that covers the FANG stocks. Again, my focus is now starting to shift out to the longer term time frames, watching those longer term trend lines, because they are much more significant longer term sell signals, more powerful sell signals. That are good for swing trades that can last weeks, possibly months, if they go. And they haven't gone yet. So the other things that I'm watching, financials. I think a lot of people are watching and talking about the financials. I mentioned the breakout in the financials yesterday. You know, I talked about this trading range we've been in for months now. It's similar to the trading range we had back here, and then the breakout yesterday. What I did today is I took a look at XLF, because remember, any sector or ETF is simply a sum of its parts. So sometimes I think that people get too, I'll find myself doing this. I try not to get too wrapped up in the technicals on an ETF or a sector. What I like to do is take a look at the breakdown. So I have it on another screen now. You can pull this up if you just Google XLF holdings. Here's the holdings. Berkshire is number one at about 11%. I'll give you rough numbers. JP Morgan's the second largest at about 10.5%. Wells Fargo over 8%. Bank of America right at 8%. Citigroup at 60%. So those top 5 that I just mentioned, Berkshire, JP Morgan, Wells Fargo, and Bank of America. Did I hit all 5? No, and Citigroup, I'm sorry. They represent 43.55% of the performance of XLF. And then you add in the next few. You have US Bank Corp, which is USB, Goldman Sachs, and a couple others, and then you're at 50%. So again, about the top half dozen or so companies in here make up more than half the holdings. So let's take a look at those. I have a watch list to the left. I have it sorted by market cap. So here's the largest one, Berkshire. I'll give Berkshire a thumbs up as far as bullish. It had a bullish falling wedge here, divergent low. You can see the positive divergence at the low. Broke out. This purple line here, that's the wedge measurement. You take the widest part of the wedge, add it to where it breaks out. There you can get different wedge measurements online. This one's very simple, effective, and I find it to work out a lot of times, especially if Berkshire is going to new highs. That would be a minimum target there. So now we're already looks to be about 2/3 of the way up in the wedge, and it would be, well, let's just watch it. We're also right just a hair above resistance. You can see this line here. We closed a little bit above it today. And I'll be honest, it is the largest component in there by a little bit, almost as big as JP Morgan. It's not a bank unlike the others. Berkshire, it's a holding company, so considered like a mutual funds made up of a lot of different companies. So now let's look at the banks. JP Morgan, largest bank in the US. We had about flat line, so we'll call that bullish divergence at the lows. So that's a plus, no doubt. But however, we have a downtrend line, and we haven't taken out the recent highs in the trading range. JP Morgan's still well below there. So what I see when I look at this chart, I see a lot. I see a bearish rising wedge right here, which broke down and did play out, and that certainly met the measured target for this wedge. Referring to this move down here, let me put on some screen draw tools. See, the wedge broke down and it played out for a correction. Now, if the financials are going much higher, JP Morgan certainly needs to take out this downtrend line. It has numerous reactions, pretty well defined, and it also needs to take out, if you see, let's zoom in here a little bit and you can see these lines better. I have a resistance zone here. It's defined by this reaction high. There's a reaction high, reaction lows right there. So that's a pretty significant level, and I can tell you that's at about 89.67. And above there, there's also a bunch of reactions. So this is what I call a resistance zone. Until and unless that's taken out, JP Morgan, this breakout may fail. If it does move up, you can also see this primary uptrend line right here, the blue line. It was very well defined, a lot of reactions. We just recently broke down. So what I'm looking at here, really the bigger picture, I mean, again, with technical analysis, you can do this looking at it with the glass half empty or the glass half full. I see a very powerful divergent high right here, and I see a primary uptrend line break that only has just started to play out. That uptrend line is over a year old. You can see here it goes back to June of 2016, and we've only gone down slightly since breaking it. So what I can see here, and again, we have a confluence of resistance. If you extend that uptrend line, one possibility in JP Morgan to look out for, and as well as a lot of these bank stocks, because they're just starting to break out, but they're not convincing breakouts. JP Morgan was only up, as you can see up here, 0.2%. The bank stocks were mostly flat today. Some were down. Citigroup was down. US Bank was down. Goldman Sachs. What I'm looking for in a preferred scenario would be a little more pop up here, a couple more percentage points right into, it would run us right smack into this confluence of resistance, both the resistance zone as well as that uptrend line to give us a back test, and then boom, downtrend resumes. The reason this would be so powerful is that would be a false breakout. I think everything that I'm seeing and picking up on, people will send me articles, they'll post their own ideas in the trading room. I think a lot of eyes are watching the banks getting excited right now in a breakout. And as I often say, fewer things are more powerful than a failed breakout on the long side. It's very powerful bearish signals if a breakout fails, just like the one in Microsoft that I pointed out on I think it was the 10-minute charts recently. So that's something to look out for. More importantly, the reason I'm going through these top components is, although XLF has the appearance of breaking out, I don't see the breakouts, at least not clear breakouts yet in the components. So let's just move on. There's Wells Fargo, pretty well-defined downtrend line. Yeah, and I'll give it this. It has a divergent low, bullish divergence, just like we had a divergent high on this rising wedge, and that led to that correction. You can see we had a nice bearish pennant. I believe I pointed that out at the time. This was a measured target. You just add the flagpole to where it breaks down, like I said earlier, and that played out perfectly. We had a marginal new low right after that. So that's bullish divergence in place, and so these bank stocks could run. However, when I look at Wells Fargo, again, we have to take out A, this downtrend line. B, just above that, we have, you can see all the reactions as I'm highlighting here, a lot of reactions along this level from above and below. That level is, let me give it to you, let me touch it here, it pops up as 55.10, and above that there's another level. So Wells Fargo still has its work cut out for it. It has not taken out its downtrend line. You can draw all different downtrend lines different ways. You could certainly do this one like that. But I like to give things the benefit of the doubt on a breakout. So let's just say I am neutral the financials right now. I can see the potential is there. The charts are set up for a breakout, but they haven't convincingly taken out. There's too many overhead resistance levels, and there's also those recent, more powerful, longer-term trend line breaks on those uptrend lines that are coming off the 2016 lows. So that's what I'm seeing in the financials. Here's Bank America, same story. Positive divergence, falling wedge pattern. If you look at this line right here and this line down there, looks like it broke out. So it depends what you're watching. What I have here is see the gap right here. I have at the top of the gap on that line that I'm highlighting, and then the bottom of the gap. So far, we entered the gap. You can see we tried to get above it today and failed. So we printed a doji candlestick right back in the gap. And yes, I will give it that. It's above that downtrend line, but that is not a convincing breakout. The volume wasn't really impressive. Price comes first. So again, I'm giving the bank stocks the benefit of the doubt for right now, but I'm on watch for a failure. If these breakouts start to fail, I would expect a swift reversal back to the downside and then probably out down below those recent trading ranges. All right, last I'll just run over a few more here. There's Citigroup. This one looks best of all. It's broken out to new highs. Well, at least during intraday, it printed a new high, but then it closed red. So it failed to close above or follow through to Friday's move. And to me, it looks like a large, well-defined rising wedge pattern. This may be what I refer to as a wedge overthrow, where you have a rising wedge, prices pop up to the upside, and then quickly come down within. And again, we have these negative divergences when you look at the longer-term time frame, this scope. That hasn't been confirmed yet, so there it is. You break out to new highs, at least on Friday. That's bullish. But if this fails, and I can tell you there's a pretty decent level there where it broke out, you can see all the reactions. It needs to hold that level on a back test, or at least this uptrend line right here. So if we come back in, that's your first support. If it holds that and moves up, that's healthy, something like that. Or it can come back in here. A lot of breakouts will come back in a little bit below where the breakout point was, to just kind of shake out the weak hands and then run up. So that's your bullish scenario. But watch out below if that level gives way, because we're probably going down to at least either this trend line, support level, or this support level all the way down here at 50, and that'd be a heck of a correction. All right, a couple more. Like I said, here's USB. Not really a convincing breakout. This chart looks a lot like XLF. You can see the sideways trading range. We had one back here in late 2016, and so far throughout a good part of 2017. And if we really zoom in, here's what I'm talking about. The theme for this market, since we've been in a trading range, the theme, at least for me, is false breakouts. We had a false break to the downside of the range. We had an intraday break to the upside. Prices fell back in. We broke out on Friday, but not by a whole lot, and we didn't really follow through today. We tried to, but then we closed red. So these breakouts are suspect to me. That's all I'm trying to say. And the chart of XLF alone looks better than these top components, but remember, the leaders, these are the generals. The market, or at least a sector, the financial sector, is going to follow these generals. That I give you my word. You're not going to see Berkshire, JP Morgan, Wells Fargo, Bank of America, Citigroup all going down 10, 20% or 15, whatever it is, even 8%, with the rest of the financials going up. Sure, there's always some stocks in there that are marching to a different drumbeat than the overall sector, but that's more the exception than the rule. So, all right, those are my thoughts, and I think that's it. Yeah, that's all I wanted to cover. So that's what I'm watching for tomorrow. Let's see which way this market breaks. Today was a day of really consolidation, if you will. especially in the tech sector, as well as those things that broke out to the upside on Friday. So it's a theme of to be continued. We need to see what happens over the next day or two. Would have been nice to get a little more resolution or direction today, but that didn't happen. And again, not surprising, especially in the tech arena, because we had such a big down move on Friday. So let's see what happens in the next couple days. I'll keep you guys posted. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.